The earnings to watch this week are the banks, and our next guest has a few regional bank names that he likes heading in to some of these prints. We've got David Chiaverini, who is the Managing Director of Equity Research at Wedbush Securities. David, great to have you back on the program with us. So which banks would you be most focused in on right now, your top picks, if you would?
Yeah, so we're really interested in the liability sensitive banks here, and those are banks that should benefit from a lower interest rate environment. So we did recently upgrade Comerica Bank, CMA. We like them here. They should benefit from lower rates. Western Alliance, we like Western Alliance as well. They have what's called earnings credit rates, or ECR deposit costs. They should lower at a pretty fast clip with lower interest rates. And they also have a mortgage banking business that should benefit with lower rates. And then another name we like is M&T Bank. So they're neutral to rates. But when we look at their credit quality, their criticized and classified assets, which include some commercial real estate loans, those borrowers should benefit with lower rates. So we're expecting their credit quality to benefit really nicely in a lower rate environment. So we like MTB as well.
David, when it comes to some of the movement that we're seeing this morning, you've got PNC touching the highest intraday level that we've seen since 2022 on the heels of their earnings prints. I'm curious, when it comes to earnings growth overall for the regional banking sector, do you see it catching up to some of its larger cap or larger bank peers?
Yeah, we do expect this re-rating to continue. And while lower interest rates, when you kind of zoom out, is normally not good for financials, but given the impact on credit quality, I think that's giving investors as well as analysts like myself become more constructive on the banks because they've been trading at discounts to historical multiples. They're still at a discount to historical multiples, but they're narrowing that gap. So there's hope for a steepening of the yield curve, so that should help banks as well. And then lower interest rates could also be a catalyst for improved loan growth. So there's a few things to get more excited about the banks looking out over the next 6 to 12 months.
Okay, and so with all the excitement and the things that investors could hang their hat on, there's also some banks that might underperform. Where are those kind of areas of weakness that you'd be tracking up against?
Yeah, so sticking with the theme of rate impacts on banks, the asset-sensitive banks are the ones that should be impacted. So we recently downgraded First Citizens, FCNCA. We recently downgraded First Horizon, FHN. They are asset-sensitive. We expect their net interest income to come under pressure. Some of the fees on First Citizens side, they have client investment fees from off-balance sheet money market funds. They'll earn less fees from those balances. There's a partial offset for First Horizon in that their fixed income trading business and their mortgage banking business should benefit, but we think the headwinds on NII should be, bigger than the offset on the countercyclical businesses. So it's really the asset-sensitive names that will probably see some headwinds.
David, what do you think the deal-making activity is going to look like for regionals?
I think it's going to improve with this theme of lower rates. One of the big items that's been a headwind to M&A activity are these fair value marks, both on loans as well as securities portfolios. They call it the AOCI marks. Those are going to come down meaningfully in a lower rate environment. So that's one headwind that should go away. Also, a potential change in the administration could pave the way for increased M&A activity because some of the deals that have occurred over the past couple of years have really been hung up, and the approval time has been extended much longer than a typical approval time. So if we do end up with a change in administration, combined with lower interest rates, we could see an uptick in M&A activity.
Dave, let's talk about two calls that you've had recently. It stuck out to us. One of those being the buy now, pay later space. You've got a firm you recently upgraded, getting a bit more positive about that space. You're far from the only analyst covering these names that have boosted your outlook here for the space. I'm curious just what you've heard and why, or what you see maybe as being the catalyst for these names going forward.
Yeah, in the case of a firm, we upgraded this one, again, because of lower interest rates. That's going to benefit their funding costs. So they refer to their margin that they really manage to is revenue less transaction costs, the RLTC margin. They like to manage that in a 3 to 4% range. But with lower interest rates, they could actually end up above that range, all else being equal. But since they want to manage within the range, they'll actually loosen their underwriting standards. They're willing to take on more credit losses. That way, it can boost GMV growth and then end up as a net benefit to the bottom line and revenue. So I think the outlook for a firm in a lower rate environment is better as well.
And so resilient has been the word for the economy, but if we're anticipating outperformance for a firm on a lower rate environment, what does that spell out about the true kind of sense in the consumer right now and where that could continue to drift towards?
Yeah, resiliency really has been the name of the game over the past couple years. I was expecting a recession. Clearly, that's not going to happen. Our base case is a soft landing. And on the consumer front, it really is a tale of two cities. The lower income consumers are the ones that are struggling with higher inflation, but the upper end of the consumers, we're at all-time highs, right? With the stock market hitting nearly 50 new all-time highs so far this year. So there's a lot of wealth that's been built up. And then look at home equity. Home equity is really high right now. So a lot of consumers are very strong with their ability to continue their spending patterns. So that's what I think is holding up the economy. So while we do see some weakness at the lower end, the upper end is more than offsetting it.
All right, David Chiaverini, always great to have you. Thanks so much for your insights here this morning. Wedbush Securities Managing Director of Equity Research.